Good afternoon, this is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, February 18, 2016, featuring Update Analytics, primarily incorporating data from the Update Energy Feed, Baker Hughes, and CME Group NYMEX. We'll cover the report according to the regions as they're tracked by Energy Information Administration, starting from left to right with the Pacific region, Mountain, Midwest, East, South Central, and the lower 48 United States. Highlights from this week's report: 158 BCF drawdown. 3 of the 5 regions we just discussed and the lower 48 have a record surplus. We're at an all-time record low U.S. rig count focused on natural gas, and the negative trend continues. Let's go to the charts. Beginning with the Pacific region, all of the charts are constructed the same. In the top pane, the heavy blue line indicates natural gas and storage. The black dash line indicates the 5-year average of storage. The light green dash line is the 5-year average maximum, and the light red dash line is the 5-year average minimum. Moving to the center pane, we show the additions or withdrawals from storage each week, and in the bottom pane, we take a look at the difference between the gas and storage and the 5-year average to determine whether we have a surplus or a deficit for the given region or the lower 48. So looking at the Pacific region this week, 255 BCF in storage, slightly below the 278 BCF 5-year average maximum and above the 227 BCF 5-year average. In the center pane, you can see we drew down 3 BCF of gas in this most recent report, and the surplus in the Pacific region has increased to 28 BCF. Additionally, we'll look at the basis differential in certain delivery points in the respective regions. In this case, for the Pacific region, we look at PG&E on the left and the SoCal basis on the right. They're relatively stable this week, PG&E at a 13-cent premium and a 16-cent deficit for SoCal. The Mountain region has 147 BCF in storage, halfway between the 5-year average maximum and the average, following a 4 BCF drawdown, and the surplus expands to an all-time high for the Mountain region of 9 BCF. Consistent with that surplus expanding, you can see the basis differentials for Rockies and San Juan have both expanded the amount that they're in a discount. So ample gas supplied in the Mountain region and no premium pricing for gas there. In the Midwest region, nearly 700 BCF in storage, right at the 5-year average maximum, clearly well above the 5-year average, following even a 50 BCF drawdown, and 155 BCF surplus, which is a new record in the Midwest. 2 delivery points we cover here. Both are trading at a premium, however, that has declined somewhat since the start of the year. Over to Eastern region, 570 BCF in storage, just slightly below the 5-year average maximum of 603 BCF, with a 51 BCF drawdown. This is the one of the regions where the surplus actually declined slightly. Looking at the delivery points, 2 out of the 3 are still trading at a deep discount, and the one that is remaining at a premium there on the right, the premium has declined substantially since the start of the year. South Central region includes Texas and Oklahoma, so these are primary production areas for natural gas. Still over 1 trillion cubic feet of gas in storage and well above the 5-year average maximum, even following the 50 BCF drawdown. The 271 BCF surplus is a new record for the South Central region. Not surprising, all 4 delivery points tracked in the South Central region are trading at deep discounts. Into the lower 48 United States, 2.7 trillion cubic feet of gas in storage, similar to what we saw in one of the other charts. The storage is right at the 5-year average maximum. In the center pane, you see the 158 BCF drawdown we talked about at the top of the report, and 555 BCF surplus in the bottom pane is a new record in this reporting format for EIA. Over to exploration and production activity, this is the Baker Hughes rig count. This is for all rigs, rotary rigs in North America, so this does include Canada and includes rigs focused on oil as well as natural gas, down to 514 last Friday. If you follow the brown dash line across there, the exploration and production activity is depressed all the way down to levels that we haven't seen since August of 1999. Focusing more on natural gas, this is U.S. rigs, rotary rigs focused on natural gas, again from Baker Hughes. The 242 red dashed line there, that extends all the way back to 1992. The 102 rigs reported last Friday is an all-time record low for this data set from Baker Hughes. Natural gas pricing, we talked about that it was in a downtrend. We'll get more into that, but first we'll take a look at the seasonality here. This is a time of year where seasonality really is pretty volatile, no clear trend, and then we don't begin to see this uptrend until springtime, so April or so. You can see back here in 2014, I highlighted that in green. So we might get some seasonal support, but that's at least another 5 to 6 weeks away. Over to the daily cloud chart. This is data is from eSignal. So this is not roll adjusted. This is daily data. What's obvious here, and the things that we look at on the cloud chart, we have the price below the cloud span. The blue lagging line is below the cloud span. The turning line is below the standard line. And we just have the cloud spans reversing and crossing down negative. So nothing bullish about this chart at present. We had that breakout failure you can see back here in early January, and we've trended pretty much steadily down with only one spike. But you can see the blue lagging line, once the new downtrend was confirmed, has pretty much stayed intact on a daily basis. Over to the 60-minute point and figure chart. So this gives us a slightly shorter time frame. Once again, this is the same data set, eSignal's continuous contract, and this is a 60-minute chart and a 3-box reversal point and figure. Working below the bearish resistance, this is very consistent with some of what we saw there on the cloud chart, so we are well below that. We have sold off this morning following the report. One thing that's interesting is with the steady downtrend here, we really only have one active downside target down to $1.80. It may take a while to realize that, but still working well below this bearish resistance. That seems likely. This is the 15-minute chart. So this is a 15-minute close chart of the actual futures, in this case NGJ6. So this is natural gas, Henry Hub natural gas futures for April delivery. When the report printed this morning, we were in this column of X's right here, and it's actually been relatively stable. Oil's been very volatile with a large build. That report was delayed by the Monday holiday here in the U.S., and all of the equity indexes are down following a 3-day ramp up. Take a look at the forward curve. This is the NYMEX forward curve for Henry Hub natural gas futures. This comes to you from the updated energy feed. Going back 5 days, we are down slightly at most of the near-term deliveries, consistent with that downtrend. The story really remains in natural gas, that we are well supplied. That's evident in all the pricing. Looking at the basis differentials, you can see that we have surpluses in all of the regions and in the lower 48. In some cases, we have record surpluses based on this reporting format. The only thing bullish going for us right now is that exploration and production activity is very depressed, both in oil and natural gas, and perhaps along around April or so, we could begin to see some seasonal support. This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, February 18th, 2015. If you have questions or comments, please contact me directly. If you'd like to learn more about Update Analytics or the Update Energy feed, please feel free to contact them via email. Thank you, and have a good day.